Thank you to everyone joining us today. The slide deck can be found in the handout section on your webinar tool. Please use the question section on the right-hand side to ask questions throughout the presentation. We will be holding and answering questions for the end of each individual presentation. Some questions may be asked during. We are also going to be sharing the slides and the presentation video recording link following the live presentation. Thank you.
Thank you and welcome to the Withum's Global Summit Series, this time focusing on technology. I'm Kimberly Phelan. I'm the practice leader for international services at withumsmith+brown, and I've planned this with Chris DeMeo, head of the technology niche, and my international tax team, who will be presenting to you today. We're going to start this morning with an update on international tax proposals, and this will be presented by Josh Gelernter and Calvin Young. Guys?
Thanks, Kimberly. Good morning, everyone. Good afternoon. If you're east of us, hope everyone is doing well today. Calvin and I are going to run through some of the changes that are proposed in the latest legislation that came out earlier this year and earlier this week. There was a further update. Without further ado, Calvin, do you want to introduce yourself and take it away?
That's an introduction. My name is Calvin Young. I work in the international tax group with Kimberly, Chaya, Josh on international taxes. And this presentation, we're just going to start with just giving the overview of some of the proposed changes to the international tax laws, which can be summed up as essentially your taxes will be going up if all these provisions are passed. But we will have to see and stay tuned to see what happens with all these proposals.
So, Kelly, maybe before we jump into what's current, let's just take a step back to the previous administration. Just remind everybody what happened last time there was a change in regimes. At the end of 2017, which was the first year of President Trump's administration, there was a major change to international tax rules known as the Tax Cuts and Jobs Act that basically changed almost everything that we knew about international tax up till that point, introducing GILTI as a major new rule in the international tax world that taxes U.S. shareholders of controlled foreign corporations' tested income without getting into too much of the details in GILTI. That was the main, between that and Code Section 965, which was the mandatory repatriation of previously kept offshore earnings and profits. So that was the major changes that came into play in 2017. Here we are 4 years later, the first year of the Biden administration. And obviously the way the political climate is right now, there's very much an interest on the side of the Democrats to go ahead and claw back some of those rules that were put into play with the Tax Cuts and Jobs Act of 2017. So with that introduction, Calvin, why don't you just take us through where we are right now and what we can expect?
Okay, thanks, Josh. So recently, early March, the two bills were introduced, the No Tax Breaks for Outsourcing Act and the Stop Tax Haven Abuse Act. And they're aimed at eliminating tax benefits provided to multinationals to just close what they were calling loopholes and prevent corporations and the rich from sheltering profits in tax havens. And then also recently, a few weeks ago, when President Biden's administration released the budget, they also released what they call the Green Book, which just outlines their proposals to changes to the federal tax laws. So we'll just go through some of the larger provisions, just highlighting some of the ones that may affect your taxes from all these acts. So first we'll touch on the No Tax Breaks for Outsourcing Act. That first bullet point, it's proposed that they're going to be eliminating certain provisions that provide a benefit for taxpayers in some of the new provisions that were brought about by the Tax Cuts and Jobs Act in 2017. And within the GILTI, if you're familiar with the GILTI computation, there's one element in the computation that it's essentially when it allows a deduction from the reduction of the taxable income for tangible property that is owned by the CFC and used in the business. That benefit in the computation is proposed to, they're going to be eliminating that. So essentially the amount of income from the CFC would be increased since that reductions will no longer apply. The second
the ironic thing about that is the GILTI acronym, the I in guilt, the first I in GILTI is intangible, right? So it's basically going to change GILTI entirely, because it used to be that the focus was on intangibles, meaning that your standard return on your fixed assets, like you said, was going to be something that the government felt you're able to not be taxed on. With getting rid of that, the whole acronym sort of falls away, because now you're going to be taxed, the US shareholder of the CFC is going to be taxed on the CFC's entire income, and not just the quote unquote intangible income of the, not the 10% fixed asset part of it, including the 10% of the fixed asset part of it. So ironically, the acronym GILTI, which everybody snickers at because of the way it's pronounced, is going to be even more so guilty of the US shareholders that are having profits outside the United States are going to be subject to even more tax on that income.
And the next bullet point, it's one of the other proposals there. It's the elimination of Section 250, which provides what we know as the FDII or FDII deduction, as well as the 50% deduction allowed for C corporations for GILTI. So a little background on the FDII rules, that essentially it provides a beneficial tax rate for US C corporations that do have foreign sales. And those foreign sales include things such as whether you're selling goods or providing services to a foreign customer, also licensing IP to a foreign party. Those are all FDII eligible sales. So if they do eliminate that code section, that's currently a huge benefit to a lot of corporations right now. And then also the 50% GILTI deduction, that's currently it's only a benefit allowed to C corporations to take that income from the CFCs, but they only take half of it. So it essentially gives them a effective tax rate on any GILTI inclusions at 10.5% rather than the full tax rate. The next item is actually a benefit to taxpayers, where under the current rules for the GILTI foreign tax credits that are allowed, the current rules only provide an 80% allowance of any foreign taxes paid against the GILTI income. However, the proposal is to remove that 20% haircut so that you can claim the full 100% of foreign taxes against the GILTI income. So that's a small pro in these proposed changes, but as you'll see, we have an example towards the end. You'll see that overall, as what I said before, the total impact is that the taxes will likely go up under all these proposals. The next bullet point, they propose additional interest expense limitations on US subsidiaries of multinational corporations. And then also foreign corporations worth $50 million or more that are managed or controlled from within the US will be treated as actual US entities. And not entirely sure how that would play out, because there's no detailed regulations or anything around these rules yet, but we'll have to see how they implement that. And the last bullet point under the no tax breaks for Outsourcing Act is that they're planning to modify the inversion rules to treat the surviving entity in mergers between US and smaller foreign companies as US companies. And just a little bit background around inversions, it's essentially taking a US company and merging it with a foreign entity that is generally smaller in size than the US company to make it a foreign company. Currently under the rules, what they call the inversion rules applied right now if 80% of the current ownership continues to own the new company, but under the proposed rules, they're reducing that 80% threshold to 50%.
Yeah, and that was and remains a hot topic, these inversion rules under Code Section 7874. And as Calvin said, there's actually two different thresholds and two different results depending upon how much of the original ownership remains after the company quote unquote inverts. And as Calvin said, those rules are set to become even more prescriptive so that it would become even harder to engage in an inversion transaction that's going to result in the desired outcome of the U.S. company that's looking to become a non-U.S. company. So all these are again proposals under the No Tax Breaks for Outsourcing Act. And let's talk about the next one, and then we'll talk about maybe what the likelihood of all these provisions happening, Calvin. So let's move on to the Stop Tax Haven Abuse Act.
Okay. The second act that was introduced is the Stop Tax Haven Abuse Act. And within this act, there's one of the major proposals in here that got a lot of people's attention was that they proposed to accelerate any 965H installment payments. And 965H was an election that taxpayers were allowed to make to pay their 965 liability over 8 years. So each year they would have to make a certain percentage of the total liability. So under the proposed rules, they're implementing taxpayers can either pay the entire liability upfront, or they can continue to pay it over 8 years, but they will be subject to an interest charge. So it's no longer essentially a tax-free loan from the government on these 965H liabilities.
Yeah, and that's a major thing. And we had a lot of clients when 965 first came into being in the 2017 Tax Cuts and Jobs Act. We had a lot of clients that had significant 965 liability, which we spun as not necessarily a bad thing because you paid 5% of the total tax due in 2017. And by doing that, you were able to bring all of your earnings that had accumulated offshore back to the United States without incurring any additional tax. And you're going to be able to pay that additional liability, as Calvin said, over the remaining 8 years. I think it was the first 5 years were 5%, and then escalated up to 10, 20, 25. I don't remember exactly the numbers, but the first 5 years were at 5% of the total liability. So you had a really, as Calvin referred to it correctly, basically an interest-free loan from the government on that money that you repatriated in 2017 until you paid it up over 8 years. And the first bullet here is putting a stop to that and saying either pay it all now or pay interest on it. And then interest-free character of the 8-year deferment is going to go away.
The next bullet point, they proposed a change to the rules for as far as foreign entities for the check the box election. So under the proposed rules, certain foreign entities will no longer be eligible entities to make that check the box election to be treated as either a partnership or disregarded entity. So I like a lot of the U.S. companies do have foreign entities that either they make this check the box election to treat the foreign entity as a flow through. That was a common planning technique for guilty, because once you elect to treat a foreign entity as a flow through, it's no longer a controlled foreign corporation and subject to guilty. The next bullet point was a proposal to lower the gross receipts threshold for the applicability of the base erosion anti-abuse tax, also known as the BEAT, from 500 million to 100 million, and also eliminating the 3% base erosion percentage for qualifying for the BEAT. So the impact of this would be it would subject a lot smaller companies that weren't previously subject to the BEAT, and now they will be subject to the BEAT. So they would have to consider that in their provisions and in filing their taxes.
And Calvin, that BEAT tax is what? Just an additional tax that corporations of this size are going to have to pay. You don't get a credit for it on your federal tax. You don't get a credit for it on any state tax, right? It's just an additional layer of tax that these corporations that previously needed to have 500 million of worldwide gross receipts, but now only going to have 100 million, only need to have 100 million, are now going to be subject to this additional tax, which is obviously going to add to tax costs to a lot of companies, and potentially that cost might be passed on through down to consumers down the chain, and might see increased prices on pretty much anything out there right now.
And the last bullet point covers it's proposed to change the rules regarding transferring intangibles to a partnership under Section 721, where in the past that would have been a tax-free transfer. Under the proposals, it would treat it as a deemed sale under Section 367D. So similar to the corporate rules, where it would be essentially an exchange for a continuing deemed royalty. And we can move on to the next round of proposals in the Biden administration's Green Book. So within the Green Book, one of the main proposals was the increase of the corporate tax rate to 28% from the current rate of 21%. And also they proposed to impose a 15% minimum tax on pre-book income for what they call large corporations, and that's any corporation with income over $2 billion. And we just talked about the BEAT regime, but in Biden's proposals, he did propose to replace the BEAT regime with a new regime called SHIELD, the Stopping Harmful Inversions and Ending the Low Tax Development Rules. And these rules would be applicable to businesses with over 500 million of global annual revenue. And the rules would operate to disallow certain deductions by U.S. corporations that have a effective tax rate below either 21% or the rate that's agreed under the OECD Pillar 2. So it's essentially imposing a sort of minimum tax on large corporations, which would curb some of the international tax planning and just moving operations to low tax jurisdictions. And the last proposal included a proposal for a new business credit for 10% of certain expenses incurred by businesses for moving their operations into the United States. So that's another one of the few provisions that may be good for taxpayers.
Right. So it's not all bad news, but it's mostly bad news. It sounds like from all that we've seen so far from the Biden administration and these various proposals that are out there. Calvin, let's just run through the example that we have, and then maybe we'll take some questions.
Okay. Yep. So we put together a small example here, just outlining to illustrate some of the impact of the changes, the proposed changes that would impact a taxpayer that is picking up guilty on their current tax returns. So under these facts, we can just say this model, it's a U.S. corporation with a wholly owned CFC. The CFC has $1 million of tested income, and they pay 20% tax on that, so $200,000. So as you go through the column on the left is under the current rules, and then the column on the right is the computation with the proposed changes layered in. And you'll see on that first line, the QBI, that's the depreciable tangible property that it's allowed a 10% of that amount is allowed to reduce your tested income in the computation, essentially. So you'll see the 10%, $10,000 on the left. And for ease of this illustration, we're assuming zero specified interest expense, but within the computation, interest expense is also one of the factors. So the net deemed tangible income return, the net DETR, that's the would only be the $10,000 from the QBI amount. And just going down the computation, you also see that the haircut for the foreign taxes, whereas you have 80% on the left and 100% on the right. So based on the $200,000 of foreign taxes paid, the taxpayer here is only allowed a credit of up to $160,000. And then just going into the guilty computation, so we have $1 million of tested income from the CFC. We're deducting the net deeder of $10,000. So total guilty income's $990,000. And then we consider Section 78, the deemed dividend. We increase, so total inclusion would be $1,190,000. And next we apply the 50% to Section 250 deduction for guilty. So the guilty inclusion is reduced by half here to $595,000, and applying the 21% tax rate, you come up with a tentative liability of $124,000. And then after applying the foreign tax credits, the paid taxes, the total taxpayer here has no additional tax liability from the guilty inclusion. Whereas when you filter in the changes from the proposals, this taxpayer will no longer get the reduction of tested income from QBI or the net deeder, but they will get the full $200,000 of foreign credit for foreign taxes paid. But going down, they will no longer get the 50% to Section 250 deduction, so that their full guilty inclusion will be $1.2 million, also considering the Section 78 deemed dividend. And then that applied to the increased 28% tax rate, they're looking at a tentative tax liability of $336,000, which is significantly higher than the prior tentative liability under the current rules. So even after applying the foreign tax credits that they can take, they're still subject to a liability of $136,000 versus zero under the current rules. And this is just, every taxpayer's facts are going to be specific to their own case. So this is just a very simple example just to illustrate just how some of the changes will impact taxpayers.
Yep. Thanks, Calvin. And one thing to just point out with this computation is we didn't take into account the possible applicability of the high tax exception. I don't think there was anything in the proposed legislation that was to strike that out of the rules, but basically by increasing our U.S. tax rate to 28%, we're going to have very few countries that are going to fall within a statutory rate of 90% of 28% at this point, with most countries having reduced their tax rates over the last few years. So in effect, we are sort of doing away with the high tax exception, at least for a number of significant countries where U.S. companies have subsidiaries, by virtue of the fact that the U.S. tax rate is going to go up, and therefore the 90% of the U.S. tax rate is going to be higher. So a lot of the countries where we do business will fall outside of that high tax and therefore not be eligible for the exception. I believe we have a couple of minutes left.
We do, and I have a few questions that have come in. And the first is, it seems like, you know, in international tax, we cannot stop unfastening our seatbelt because it's going to continue to be a bumpy ride. So Josh and Calvin, major changes in international. What do you think the chances are that these will get passed? And if they do get passed, will they be retroactive, kind of like they did with the transition tax, where once it's passed, you can't do any future planning?
Right. Calvin, I'll start and then you jump in. I personally think that this is more likely than not, to use a tax terminology, to happen, at least some of it. The way the political winds are blowing right now, and with the Democrats controlling not only the presidency, but both houses of Congress, I'd be very surprised if we don't get some sort of tax legislation this year, especially with the way the current administration feels about the previous administration. They're going to want to strike as much off the books that was implemented by the previous administration, and therefore I think it's very, very likely. I'm going more than likely than not. I'm going to go very, very likely, in fact, that we're going to have some sort of change this year. As far as the retroactiveness of it, that's a good question. Again, I think that it's probably going to be retroactive. In addition to the guilty, which the Section 965, which you mentioned, the previous, I looked this up beforehand, so I'm well educated on it. In 1993, the Omnibus Tax Act of 1993 was done retroactively as well. So there's very much a precedent for administrations coming in and retroactively changing tax rules. So I would, again, very likely that changes are coming, and probably likely that they're going to be retroactive. Calvin, over to you for any other thoughts.
Yeah, I agree with that. I think definitely something's going to change. Exactly what's going to change, I think that's still to be determined. And I don't want to. I can't.
You don't have a crystal ball?
Yeah, I can't guess it specifically what's going to change and what it's going to change, what that change is going to look like. But definitely certain things are going to be changing. Like even as far as the tax rate, where it was proposed to increase it to 28% on the corporate side, there's already been talk about maybe not 28%. Maybe that's not the number. Maybe it's somewhere between 21 and 28.
Yeah.
So definitely, I think definitely something is going to change.
Coming to happen.
We don't know what.
Yeah, I think it's also easier to change it on foreign than it is on US. And Mitch McConnell has come out and said, no, we're not touching the 21% tax rate, but we'll see. So lots of change, as you showed us, lots of tax increase. What can we do? Is there anything we can do?
As for right now, I think there's always planning, but for now to make changes based on the proposals where nothing is so concrete yet, my inclination is to just stay tuned, wait and see how the environment changes, if there's any new news out to give us a better understanding of exactly what is going to change, so we can better prepare for that at that point.
Are there any tax savings moves individuals can make right now?
As far as planning for tax savings moves, I know currently because of the beneficial tax rates in Puerto Rico, there's a lot of individuals from the US, especially in the tech space, are moving to Puerto Rico. And to do that, it's not just I'm going to go live there for a couple months out of the year. It's the factors that they do consider are they pretty much look at everything. So you actually have to establish what they call a bona fide residence in Puerto Rico. So they'll look at everything to where your bank accounts are, where you're actually living, where your family is, to determine if you're actually a resident of Puerto Rico. But if you are a resident of Puerto Rico, I think the capital gains rate is either 0 or 5%. It's very low. So there are, as far as on the personal side, there's certain things available right now that individuals can do to minimize their taxes in the U.S.
Great. Okay. Well, with no further questions, I want to thank you, Josh and Calvin, for this a little bit scary update on what might be coming down the road. And we're going to move on to the second part of the summit, which is a panel discussion led by our own Chaya Siegfried. And if you guys can turn off your cameras and we'll pull out our panel on. Chaya is going to be speaking to a number of our HLB affiliates. Bettina Cassegrain from HLB COGEP in France. Suraj Patel from SLF Schwartz Feldman in Canada. Jason Mariarathanam from HLB Daal in the Netherlands. You ready to go, Chaya? You're on mute. We can't hear you.
Thank you, Kimberly, and thank you.
And there's my friend Nick Farmer from Menzies in the UK. Welcome, Nick. We can't hear you either. Okay.
Can you hear me now, Kimberly?
You got it.
Okay, great. Thanks. Yep. Thanks everyone for joining us. So, as Kimberly mentioned, my name is Chaya Siegfried. I lead up Withum's international business tax practice, and I'm joined this morning by a group of colleagues from within the HLB network. HLB is a global affiliation of accounting and advisory firms. What's unique about this panel is that we have a group of professionals from different firms and from different countries that collaborate quite often as we help our collective clients expand outside the US or outside the country where they're headquartered. So I'm excited to be joined by Nick, Bettina, Jason, and Suraj. Thank you. And let's jump right in. So if you've been following the headlines lately, you may have noticed a lot of headlines reading something along the lines of global tax deal reached among G7 nations, or G7 agree to back a 15% global minimum tax rate, more taxes for tech giants. Those are actual headlines. Like one was from the Daily News. I don't remember where I pulled them from, but these are actual news headlines. So we don't usually hit the general mainstream news, our international tax. So this is a rare event where, this is our area of expertise and we're in the headlines. So can you tell us a little bit about the backstory here? What are the details? What's going on? Nick, maybe you can start the conversation with giving us some of the background on these headlines.
Yeah, definitely. Thanks, Chaya. Just by way of introduction, I'm Nick Farmer, tax partner here in London. Interestingly, Chaya, I think back in 2008 this started, and tax was very much in the headlines, because if you think back to then, that was when we had the financial crisis. And of course, at that time, everybody was, or governments were looking at, where taxpayers were paying their taxes, and were they paying their fair share of tax. And it was very much headline news, a lot of public pressure on governments to make sure people were contributing, tax revenues. And of course, the multinationals came into the firing line. And out of that, in 2013, the OECD launched this Beps Project, which stands for Base Erosion Profit Shifting. The idea being that multinationals had been able to reduce their tax base in certain countries to lower their tax revenues, and also shift profit into lower tax jurisdictions. I think one of the real sort of trump cards that the OECD played here was they got so many countries to participate. There were about 135 countries that signed up to this initiative. So it was always going to be successful from, just the full sort of inclusion that was there. And what they came up with were 15 key action points that they felt were really essential for governments to grasp hold of, to make sure that they were protecting their tax revenues. The first one, I know we'll touch on this later, was all about digitalization. The fact that probably the tax system just hadn't kept pace with the way that business was happening. The tax system was more based around bricks and mortar. Suddenly we had these digital businesses. It's all about intangible assets and data, and therefore, the tax system wasn't catering very well for that. So that one's still out there, actually, and that's part of where we're now seeing the headlines about, taxing these digital businesses. But quite a lot also came out of this. A lot of what we would call sort of anti-avoidance measures. So I'll just run you through what I think are some of the headlines here. So we saw things around sort of hybrid entities. I know in the US, Chaya, you like this check the box election. It's a typical sort of play that you might have on international structuring. Well, that election's very much in the sights of the UK tax authority. Anybody that checks the box on a UK company, you bring that hybrid legislation straight into play, and you ask the question as to whether you can deduct expenses here. Have you got full inclusion of income? Another one which we have was, again, very relevant to US businesses, actually. If you're pushing debt down into the UK, there's now heavy restrictions on the deductibility of that debt. Debt is now limited to 30% of the EBITDA of the UK group. There is a sort of de minimis of 2 million, but that's quite a change. The big one, actually, and there were 3 action points on this, was transfer pricing. I mean, transfer pricing is so in point at the moment, really around the fact that intangible assets are the big sort of change, that people are able to sort of transfer price around the intangibles. And this was all about saying, look, hey, look, the legal ownership is no longer the key thing. this is really where that value is being created from that intangible. And they came up with what they called these DEMPI functions around intangible assets. Where was it being developed? Where was it being enhanced? Where was it actually being maintained, protected, exploited? These key things. And so this is all about function and risk now. So a lot has changed around transfer pricing and intangibles. So I think in essence, there's been a massive sea change in the way that international tax systems are now catering for sort of the movement of profit and whether it's being taxed properly. And governments now have more defensive measures in their sort of armory to sort of deal with it. To some extent, it gives businesses a little bit more certainty because, there's specific rules there which you can look at and see how they're going to apply to you. But you need to be aware that there's been a change, and anybody who's doing international tax structuring has got to really sort of be aware that these changes have been brought into legislation and they're not just forthcoming action points. Maybe does that give you a reasonable summary of sort of where that?
Yeah, that's very helpful. And you mentioned transfer pricing and the discussion around substance and how taxation typically follows substance. That's the historical. But when you talk about digital, the digital economy, it's very easy to have revenues in a country where there's no substance. And so, that's kind of where we are today. And I guess that brings us to the OECD's, Pillar 1 and Pillar 2. This is how they want to approach the taxation of digital transactions. And, maybe we can get a little bit of a background for our audience, just to, understanding of, what are they thinking? Because we've been used to structuring things around substance. So where are we headed to now with this digital economy where substance, you could have Netflix streaming, $20 million of revenue into a country, and there's no substance in that country, but there's $20 million revenue coming out of that. So maybe Suraj, you can kind of walk us through, what are these different approaches that the OECD is considering, that the G7 countries have been talking about? What are the proposals?
Yeah, absolutely. So, it goes back to what you're all saying. Our international tax rules have always been based on substance, a presence, and a physical presence in an economy. And with the technology and digitalization, creating disruptions across the board, it's kind of created a disruption here for tax as well, right? So what's ended up happening is, as part of the Beps, and then I guess a follow-up after Beps, the OECD and obviously the G7, the G20 economies are saying that we need a more unified approach on how to have fair taxes across the board. And so the OECD has come up with Pillar 1 and Pillar 2 following Beps as to how they want to make taxes fair across the board, across many countries. Pillar 1 is normally referred to, I believe, the unified approach. And what they're trying to seek in terms of Pillar 1 is, taxation based on net profits, but it's going to be based on what we call a new nexus or a profits allocation rule. So it's not going to depend on the physical presence that we've kind of come to know, over the past 100 years. I think it's 100 years that we've been relying just on physical presence in an international tax community. Now we're going to be talking about a new nexus or profits allocation rule that's not dependent on physical presence. The rules are obviously meant to ensure, there's no double taxation that's happening across borders. And they're hoping to make it simple in terms of complying with these rules, and also the government, the jurisdictions, the taxing jurisdictions, having to be able to administer them with ease as well. I mean, there's a lot of good things that we're saying there, but with a lot of these things, there's a lot of complications. How are we going to implement it? And I think the big issue right now is, there's about 135, 140 countries at the table that need to agree to a lot of these rules, a lot of these definitions of what's going to be in scope for this unified approach. There's things that bigger nations want to see, smaller nations want to have a right to, and how do you kind of bring that all together to the table and agree on a unified approach? They've been setting out these pillars since 2018, I believe, and they had a revised kind of proposal that came out at the end of last year, October 2020, and now we're heading into just in the past couple of weeks where we've heard the G7 agreeing, and we just mentioned that earlier, on one aspect, which leads me into, I guess, pillar number 2 as well. Pillar number 2 is the Global Anti-Base Erosion Proposal, or GLOBE, I think is the acronym that they like to use, where they want to put in a proposal to say, where there's profits from large M&Es around the world, those profits are subject to a minimum tax rate, no matter where they're derived from. And so the rate, I think initially they were talking about, in the 2018, 2019 proposals when they were set forth, a rate at maybe 12.5%. But what came out with the G7 in the last few weeks is they have come to agreement and a consensus at the table that they would push for a global minimum tax rate of 15%. So again, these are all great agreements in place. How you get it all in place, legislated, it's a whole new thing. It's going to involve not just potentially another multilateral instrument like we had with the Beps initiatives when that concluded. We may have to deal with that in one respect, and then we may also need to have local countries implement new tax legislation into their existing laws to facilitate these global pillars that are being proposed and kind of debated at the international stage right now.
So is it harder to, I was gonna say, is it harder to get 150 or 140 countries to agree on a point, or is it harder to take these, because the OECD is just a think tank, they don't have any legislative power, right? So then to take these concepts that they've agreed upon, bring them home and get, let's say in the US, you have to have the Congress agree upon it and pass that through. So I wonder which step in the process is going to be more challenging. But if you think about how we spoke a few minutes ago, Calvin and Josh were talking about the proposed tax changes and whether or not what the likelihood of any of those being passed. Now think about that times 140 after you finish agreeing on, after 140 different member countries agree on the exact details. So it definitely sounds like a big haul.
Absolutely. I mean, it's going to take more time and effort with a lot of the big players, the G7 coming to the table agreeing on something. There's a lot of things with Pillar 1 that there's just not a lot of consensus on right now. Pillar 2 seems to be a place where you got the agreement with the 15% tax rate from the G7 at least, and there's just how are we going to administer and put compliance practices in for that. Pillar 1, there's still a lot of things to think about. What's going to be in scope, what types of businesses. So there's still a lot of things at that level that need to be. And it took a long time for the Beps and the MLI to come to fruition. And this has been a process that started, in 2018, and we're still going at it strong. Yeah.
Yeah. No, and I mean, in the U.S., we already have like a Pillar 2 global minimum tax concept because we have GILTI. So, it doesn't matter if you're a U.S. headquartered multinational, it doesn't matter where you're earning your profits, they're going to be subject to a minimum tax of 12.5% in the U.S. So actually it's 10.5% in the U.S. right now, but I guess that'll be bumped up as part of the Biden proposals to bump that 10.5% up. So that's interesting. So, a question that we always get, talking about the backdrop of the history and where we are now and the cusp of things changing, we very frequently have clients raising the point of the tax strategies for the big tech companies like Google or Apple. Maybe they've seen an article that talks about Apple's global effective tax rate of like 12% or even lower. So how does this type of structuring work for the big companies? And will these new rules that are being spoken about, will they impact their planning going forward? Is this something that's going to change? Where does that sit? Jason, maybe this is one for you to kind of address.
Sure, thanks, Chaya. Yeah, you're probably familiar. You heard of some of these lines like the double Irish or Dutch sandwich or the satay route, for those who are familiar in Indonesia. This was a time where, all of those tax planning ideas was possible, and obviously you've heard it on the news on what Google and Apple does. And it sounds exciting that you might be able to say, well, if Google and Apple can do it, why can't I? Now that's a big chunk of my work. I help businesses structure themselves for the sustainable future. And what we do see with the Google and Apple strategy is that it works for them, but it might not actually work for all companies. And I'll walk you with some of my thoughts on that area. Just so you know, the size of Google and Apple, and I know we talked about this guy. I mean, you just look at their tax team, it's quite a significant, big amount of professionals working there, and there is a bit of weight that they pull. And they're also able to negotiate with foreign countries, with governments, and foreign governments tend to entertain those negotiations because they see a bigger picture than just corporate income tax. They look at it from an employment perspective, what's going to be the VAT revenue that the state can collect. So there's much more at play there. And then when you think about smaller businesses, small and medium-sized businesses, and they think, well, let's also create a structure like this. It really is challenging. And I'll start off with some of the things that you should take into consideration. So setting up an international structure where if you were to move a part of your business to the Caymans or bring some IP to the Netherlands, it comes with hefty implementation costs. And one might say, well, that's a one-off thing, but then there comes also maintenance costs, and that's just the cost that you have to consider to maintain its structure for the years to come. And it's not as simple as just setting up a PO box or a company in Cyprus and no one's there, no substance. It doesn't work anymore. So you've got the cost of maintenance, you've got the setup structure, and if you were to weigh that and what's your actual net savings from a corporate income tax perspective, I question whether it would be worthwhile for medium and small size businesses. Maybe, but you've also got to consider not just external costs, also internal. So your internal resources are going to be drafted in to keep the structure up and running. So something to really consider. Then you've got banks, and this is a hot subject here in Europe. So typically what we see is European banks are not very fond of complex structures. So if you have an existing bank and you complicate yourself with a very complicated structure, you might get a call from the bank or a letter from the bank saying that you don't fit the same profile any longer. And you might argue, well, Google and Facebook is doing that. Yeah, but the amount of turnover that Google and Facebook bring to these banks are quite different than what you might consider big in your opinion. So that's something to keep in mind. Yeah, and where I was trying to go with this is thinking about a sustainable tax strategy for the future. And it's not all bad looking at Google and Facebook and thinking, well, you might not be able to save the amount of tax that they're doing through their structures, but you might be able to prevent unnecessary fines and non-compliance risks for yourself. So you got to think about how you could set up, for instance, your transfer pricing policies. You could take a look at doing sanity checks on your existing structure to see whether it actually makes sense. Is this defendable? Are we going to get in trouble with tax authorities? And that's where you got to rely on your advisors to help you out with that. But we'll get into a little bit later about another form of taxation, indirect taxation on VAT, that is also very interesting to consider. So I'll pass it back to Chaya.
Yeah, I think one thing that was of interest, because when I mentioned this kind of thought to you, because again, it's a question that we get, I can't even tell you how often. You also had a very interesting reaction, and you spoke about, the Netherlands, the rules related to advisors on what you called aggressive tax planning. And I thought that was interesting, just in terms of like culturally, the difference between how we view these things in the US and in Netherlands. So talk to me a little bit about just your response to that question when I asked that question.
Right. Well, it's like in the US, you have attorneys, and then they often say, well, we're covered by privilege. So everything's protected before we say. In Europe, we've got a thing called, well, we've got a legislation called enabler legislation, similar to what that the UK has. And there's a standard reporting that we have to do is called the Duck 6 reporting. So if we deem as a advisor, a tax advisor, a bank, or any institution that enables a aggressive structure, and there are guidelines on what an aggressive structure is. If we see it, if we help in it, we're supposed to report it. So that's sticky for two parties. One, for the advisors who help with this, because now they've got to report this, and also for the client, because now his name is being reported to the tax administration, and with all the treaties that they have, it's an automatic exchange of information.
So you have to be careful what questions you actually ask your tax advisors in Europe, which is very interesting. Luckily here we still have that level of discretion where we can ask the questions and we can educate the clients about substance and Cayman PO boxes that are not going to work. But so we digressed a little bit because I thought that was just a cultural difference was very interesting. To think that there's a cultural difference in taxes is just an interesting thought. I want to bring this around back to this concept of taxation and digital economy and where we're going with this. So where are we now? Like, what are the politics that they're talking about? Because there's been a lot of mudslinging on this topic. If you tax our tech giants, we're going to tax your I don't know, your cosmetic companies. Or Bettina, since it's a friend, since I feel like a lot of this is targeted at France, maybe you can give us a little bit of the flavor of what it feels like from your end and what the conversations look like.
Yeah, hi everyone. Yes, I'll give you the Paris perspective, which is quite different from the US perspective, as you may imagine. So I think what is really interesting already is when we look at the headlines that came out of the G7. I mean, many people, many voices, including politicians from all over the world, have hailed this as some kind of historic development. And I believe Janet Yellen from the US said that it ensures fairness for the middle classes and working people across the world. Well, question is that really what it will do? I think when we look behind the scenes, behind the headlines, we will see that there's a lot of politics, a lot of political maneuvering behind it, and that the impact of what is actually happening, if we get this 15% global minimum tax, or even with the digital taxes, which already exist in the UK or in France, for example, the real impact lies somewhere quite different. And yes, it may potentially touch the big boys. In France, we call it the GAFA tax, the Google, Apple, Facebook, Amazon tax. But it very much touches other people. And the very moment this was first announced in France in 2019, the first response was, yeah, okay, we understand that there needs to be a level playing field for taxation, but you know what, we also have to respond, we have to look after our businesses, and what that means is that we might just have to pass things on to the consumer. And I think that is very much what's going to happen. Coming back a little bit to the political, I suppose, political argument. I mean, those who have followed a little bit what has been going on between President Trump and President Macron in France know that it wasn't quite a meeting of minds. There was quite a lot of fighting going on. Macron used that period to somehow portray himself as maybe the new leader of the world. He started giving interviews in English, most recently to CBS. That is very unusual. French presidents don't speak English. He was heavily criticized for doing that in his own country. And, you know, partly in response to what the French people were going through during COVID, came this very aggressive stance on the digital tax, where he was saying, okay, I need to somehow to protect you. I need to protect my own electorate, because let's not forget, we have a presidential election coming up in 2022. He wants to be re-elected. People were very heavily impacted by COVID. The government supported them, but that cost a lot of money, like in all countries. that gave a lot of support to their companies, and this money has to come from somewhere. Now it can either come from personal income tax. The electorate won't like that. Remember, he wants to get re-elected, or it can come from somewhere else. So on the face of it, the GAFA tax, the digital tax, or the minimum tax looks like a good idea, but what we will come to later, and that is true for a lot of European countries, corporation tax is not actually a very large chunk of our tax revenue in France. Our biggest portion of tax revenue, 1.85 billion per year, comes from VAT. And that is true in many European countries. Corporation tax is only 1/3 of that, only about 60 billion, sorry, not million, billion. So VAT 185 billion, corporation tax 60 billion, and even personal income taxes in between the two. So realistically, we have to ask ourselves, between the political element and this all being a bit of a political sideshow with an impact, a real tax impact that we are not really sure about, with the elections coming up, with the fact that we need to somehow reclaw all the money we have given to French companies during COVID, and then also the fact that corporation tax is not actually such a big tax revenue generator in this country. Well, what's the real deal? Is it just for the headlines, or is there something much deeper behind it? And last but not least, I'll say one more thing. Let's not forget that not every country is favorable. There are countries like, for example, Ireland, who have already said straight away that they're very much against this. And Suraj has said it. One of the main stumbling blocks seems to be, how do we get everybody on the same page?
So, you mentioned a lot of interesting points that I want to go back to, especially the one about VAT, because I think that's very important for technology companies, companies providing digital services and selling remotely. But I want to ask you just to give us a little bit of a more nuanced explanation of what these digital services tax look like in France. What is that tax exactly? How did that work?
Well, the digital services tax is something that we first talked about in 2019. And it is a 3% levy of tax. And I suppose where it's different is that it's not something, it's really sitting at the revenue, on the revenue line. So it's 3% of revenue. It is in reality targeted towards very, very large companies with 750 million euro turnover and 25 million in France. But they have already calculated that something like 40 companies are concerned, and despite its name, it's not just targeted at the US, even though it's the biggest, they're the biggest corporations we're targeting. It's targeted at everyone, including French companies. And I think that's also something to point out, that all the countries, and there are others, France is not the only one, that has got a digital services tax. They're not targeting the United States only. They are targeting very much anybody who's out there who falls into the realm of that service provision.
So it sounds more like a sales tax, almost like what we're accustomed to in the US, like a sales tax concept, because it's a 3% of the revenue, or maybe a VAT, in that it's not taxed on the net income. And what type of revenue is it targeting? Like, is it any?
Well, it's very much, and I believe the UK has got something very similar in place. It's very much targeted at what we were talking about earlier, corporations that are generating a lot of income in France, or in my case, or in other European countries who have a similar tax, but who do not have a permanent establishment in this country. So the whole digital economy, advertising, streaming services, there are various, that kind of service that they're really looking at. And obviously, I would have thought, at least as far as France is concerned, because that is very often the case, there is often a big difference between the interpretation that is done in the legal proposal and then the interpretation of the tax authorities. And the tax authorities ultimately decide, when they do a tax inspection, do we believe you fall into this category or not? And I would have thought, based on our experience, that, and based on the fact that France is really trying to generate tax revenue, if you're somewhere in a bit of a gray area, I would expect them to say, yeah, you're definitely getting caught up.
Wow, so this is more of like, you know, in the US, we moved from a sales tax perspective to like a market-based nexus type concept. So that's what it sounds like also, meaning even if you don't have physical substance in the country, we're going to tax you 3% of your revenue. And clearly it's going to target those technology companies because those are the ones that can do business without having the substance, the brick and mortar substance. So that's interesting. I just want to throw it to the group to ask you, you know, you mentioned, and I'm assuming UK's digital services tax is similar, Nick, so you could speak to that also, but you've mentioned like a $750 million revenue threshold for companies that it applies to. And you know, most of our client base is below that. I would say, you know, 95%, 99%, whatever the percentage is. So in terms of smaller technology companies that might be doing similar things, streaming content, software as a service, e-commerce, whatever it is, what would you say are the related tax considerations in your local country that they should be thinking about? And you know, we can start maybe Nick, because I mentioned the UK digital services tax.
Yeah, there's quite a lot to pick up on there. Some great comments being made. I will just sort of mention a bit about our digital services tax. It is in place. It came in from April 2020. Similar to Bettina, actually, we have thresholds. So we're looking at groups that have global sales of more than 500 million and also more than 25 million revenues into the UK. So, you know, as previously mentioned there, this isn't about physical presence at all. This is about digital sales. And what they're talking about in terms of digital sale is, does a UK user generate that revenue for them? That's the key. If you've got UK users of your particular product, and what they're looking at here, actually, the UK specifically, three things they're looking at. Search engines. Are you generating revenues from search engines? Secondly, from social media services. What do you mean by social media? Things that sort of bring people together. Facebook, LinkedIn, even dating sites, those sort of things that you're bringing users together with other users. And the third thing is online marketplaces. Again, this isn't online sales, but this is potentially like an eBay. You're bringing people together to make a sale in the UK. And from a UK user, you're generating revenue, even if you're not here. Well, you know, if you're making more than 25 million of revenue from UK users, you're into that digital services tax if your global revenues are more than 500 million. The tax is in, so, you know, we'll see where that goes. But I think one of the things that you often find with taxes is that over time thresholds reduce. If governments find that they're getting tax take from it, that they will see it as a way, you know, of actually expanding it to a wider base. And as Bettina said, this is very political. You know, people are looking and saying, you know, these multinationals making massive sales, surely, you know, from UK customers, surely they should be paying tax here. Just a point on that, the UK has clearly said, if we do get this consensus that Suraj was talking about through the OECD pillars, that the UK will withdraw this unilateral tax, and we'll just sign up to that agreement. Talking about some of the smaller businesses, and then perhaps some of the things which they need to think about here. A tax that was introduced actually back in 2015, but I think a lot of businesses haven't been aware of it, is what we call our Diverted Profits Tax. And this can easily apply to US smaller businesses, actually, who are actually diverting profits out of the UK to overseas lower tax jurisdictions through their structure. And a classic example is if you've got, say, salespeople on the ground here, going out, meeting customers, finding you know, revenues for the business, and then those revenues all flow back to an overseas low tax jurisdiction. Well, if the revenues exceed 10 million, you can be into that tax, and it's actually a penal tax. It's set at a higher rate from corporation tax. It's not a treaty-based tax at all. It will just apply unilaterally. Tax rate here is 25%, going up to 31% on that particular tax. So that's very relevant. Also quite relevant here is for anyone that's placing intellectual property in a low tax jurisdiction, and that leads to sales into the UK. We've got a new offshore receipts rule in relation to intangible assets. And if you're not putting that intangible asset in a treaty-based country, then the UK will look to actually tax the revenues coming from it. So, you know, picking up on something Jason said, in the UK, since 2010, we've had over 100 different, what we would call anti-avoidance measures come into play here. And these are just 2 or 3 of them. It's not meant to sort of worry people, but it's just an illustration of where tax authorities are now heading with, you know, the sort of changes that they're introducing, given this new landscape that they're facing, where businesses aren't, you know, having to be physically present and can just generate revenues and profits from, you know, assets and especially intangibles, which are held overseas. You did also mention the VAT tax, and I think we do need to probably talk about that. It's a tax which I know in the US that you don't have. You have a sales tax, but we have a VAT. The key thing for people to appreciate is that you could have to register for VAT in the UK if you're making sales to UK-based consumers. It's not so much the case if you're making it from business to business. So if you're doing a digital sale, something that, you know, goes over the internet, people are buying over the internet, your sort of a software or maybe an app-based product, or, you know, film, TV, a subscription, something like that, people are paying for. If it's business to business, the VAT will be collected through the UK business. No need to register. If it's directly business to consumer, from business to consumer, there is zero threshold. You are straight into having to register for VAT here if you're doing a digital sale to a UK individual customer. So, you know, very common model is to have an app which people are paying a subscription fee for. If you've got any UK customers paying that subscription fee to a US business, they need to be charged VAT. You've got to register. And I guess the big change is that the UK is no longer in the EU. Of course, you heard, you know, Brexit, we've left the EU. Previously, you used to be able to deal with these VAT taxes under a one sort of stop shop registration, which would cover all EU countries. And I know Jason will probably talk about that from an EU perspective, but no longer relevant in the UK. So you're going to have to sign up to UK VAT if you're making digital sales to UK customers. So I think, you know, lots of change there really, and, you know, need to be aware that you can pay UK taxes even if you're not actually in the UK.
Yes, and thank you, Nick. We only have about 3 minutes left. I just want to address that VAT, you know, elephant that's in the room. And I pulled up a picture that Jason shared with me, which is, it compares the income tax rates to the VAT tax rates. And if you just look at, you know, the rates of the 15% versus 21%, you know, as the minimum, you see that the corporate rates are much lower in Europe than the VAT tax. So this is obviously a big play. And for digital companies, we're not looking at that 750 million threshold of revenue like Nick mentioned. It's really on your first dollar into Europe through a digital sale, or Canada also. We can talk about, you know, I don't know if we'll have enough time to cover everything, but I think I'm going to turn it over to Jason really just to kind of give us his real quick assessment or advice to US tech companies that may be entering these jurisdictions that have the VAT.
Sure. I'll just pick one simple subject like e-commerce on a physical product. In the past, we had a system where there was thresholds, as Nick mentioned. If you pass a certain threshold in the country, you need to register for VAT and you collect it. This is B2C trades. Now we've done away with that. Same in the EU. The moment you sell €1 to a European customer, you have to collect VAT. There was a limitation or provision where they would allow you, for instance, if you have a product that is cheaper than €21, then you wouldn't have to charge VAT on it. So what we saw is a lot of Chinese businesses that would devalue the value of the product on the commercial invoice, just to escape VAT. Now the European government pretty much said, now we're going to do away with that because it's creating a very unfair advantage to foreign companies. So any product that comes into the EU, regardless of the value, that needs to be charged. Now, the beauty of what was set up and what Nick mentioned about is a one-stop shop. So in the past, if you were doing business in Europe, you would have to register in all the countries that you see in front of you there. Now, through one registration, you're able to fulfill all of your needs, and you just pay to the government that you're registered in, and that government is then is going to help you transfer the funds to wherever it needs to go to, which other government that it's due. So coming back to what Bettina said, she really said it correctly. A corporate income tax, yes, you'll see there almost all those countries you see there are above 15%. Maybe Ireland and Hungary are a bit lower. So most of them meet those thresholds, but the ones that you really need to worry about is VAT, and that can be a big sting to your margin. And don't forget, VAT is not like sales tax. This is a cost that is pushed down to the end consumer. So the end consumer has to bear it. And that can eventually affect your selling price to the consumer. So you got to keep a good eye on that.
Okay, Jason, I think we're just about out of time. I mean, I would sum it up that obviously we're on the cusp of a big change to, maybe historically companies in the tech space had a little bit more flexibility around structuring and getting a lower effective tax rate, especially the bigger guys. But where we are now, there's going to be a lot of change. We're already seeing digital services taxes and definitely VAT. So if you are going overseas, these are some of the things that you need to consider as you structure and you plan for your expansion outside of the U.S. Thank you very much, Suraj, Nick, Bettina, Jason, for joining us today. It was very interesting to hear about these things that are in the news from the different perspectives. So thank you. Kimberly, I'm going to turn it back over to you.
Yes. Thank you, Chaya. Very interesting. Always love hearing from my HLB friends and affiliates. To close out our Global Summit this afternoon, we are going to have Dave Garvey from our tech group. I just saw him pop in. Dave is going to be speaking with Craig Glasgow from Datadog. Hi, Craig. Hi, Dave. Chaya, maybe you could stop sharing your screen. And David, do you want to introduce Craig?
Certainly.
There he is.
I think we've got Michelle there. Thanks a lot, Kimberly.
Great, thanks.
Great. Yeah, hello, everyone. I think we have something great in store for all of you today from a company perspective involving lessons learned with international expansion. And so by way of background, I'm Dave Garvey, principal with withumsmith+brown, here to moderate a panel with some fantastic folks. From one of my favorite software companies in the world, Datadog. And so joining us today, we have Craig Glasgow, VP of Finance, and Michelle Rood, Director of Tax. And they will share some of their lessons involving international expansion from a tax, accounting, and even a corporate finance perspective. And with that, Craig and Michelle, welcome to the Global Summit Series.
Thanks for having us.
All right, good. And I think, Michelle, we might have you on mute, but we can switch that over. So maybe actually for the benefit of everyone here today, can you maybe just tell us a little bit about Datadog?
Sure. So to start off, for those of you who don't know Datadog, we are a monitoring and analytics platform for the cloud. So for DevOps teams that are going out there, help monitor your infrastructure, your applications as well, along with logs ingestion too, and monitoring to help triangulate a lot of the issues or monitoring that companies need as they're continuing to grow their back-end infrastructure, especially in the cloud world. So Datadog, from a corporate standpoint, we are an international company. We're in 30 different countries at this point, over 2,000 people globally, and continuing to expand heavily as well. And from the 30 different countries, we have about 10 different entities globally as well as we continue to expand.
Dave, you're on mute.
You're on mute, Dave.
Oh, sorry, this keeps bouncing around on me. Thank you. So maybe we can just set the stage, right? We'll start at the ground floor. Like some of this might be obvious for folks, but it's a good starting point. So let's just talk about like why would you even consider, global expansion, like international expansion? Obviously there are a few reasons that would drive that. The idea is though there's a point in time where it's important to start to do that planning, right? And so maybe if you could just share a little bit about the planning and the strategy involved, obviously from a tax, accounting, and corporate finance perspective, just a glimpse into, some of the playbook that you have created over there and started to implement.
Sure. So I will say it's never the finance that drives the company to grow internationally, right? It's always a business reason that drives it to get there, and either through sales or just trying to acquire more talent, especially on the engineering side and research and development. We find that the company continues to expand our own footprint based off of those two things. And so from a planning perspective, what is that first step? Michelle, you want to go into what we've thought about?
Yeah, sure. Specifically from a tax perspective, I think the first question is really, how do you want to structure that expansion? Do you want to create an entity? Do you just want to hire people and engage with the PEO, professional employer organization? What is the growth plan? Do you expect to grow your headcount past a certain number? What's the point of going there? Do you want to generate, do you want to generate more revenue? Do you want new customers out in that country? So I think getting all of that aligned in terms of the purpose and intention kind of drives also the tax planning that's involved. So as I said, if you wanted to create an entity, then you have to think about registrations, tax registrations. Do you want to engage with a local service provider to help you with that? You also have to think about transfer pricing. If you're a US-based company and then you want to create an entity out in Ireland or France, you have to make sure you're having transactions at an arm's length. So you have to make sure that transfer pricing agreements are in place. And then once all of that is set up, obviously then you have to think about what is the actual tax implication. What are some of the local taxes that you have to consider from the corporate income tax side, the VAT side, as it was mentioned earlier, payroll taxes. What does that all look like? And then going further, there's statutory compliance, statutory audits in some certain countries where you have to come up with financials on a standalone basis. And then ultimately, I think, once you get there, I think you also think about whether you want to just expand, in a country without creating an entity. You talk about a PEO, as I said before. I think once you have that PEO set up, then you got to think about permanent establishment risks and whether that has any implication on your business as well.
Great. So like in a perfect world, we create this plan and we start to execute on it, and we all do this in our own roles. We plan and we go about executing, and then there are these other opportunities that sort of present themselves where it's more reactive, right? They require a rapid response. It could be, there's all of a sudden a new big client in another part of the world, or a team to hire elsewhere, or M&A. And so maybe if you could tell us a little bit about now what you're doing in these situations where it requires a rapid response. Like you said, there's transfer pricing, employee PEO considerations, and just understanding whether, getting a true handle on even what the local tax is and all the other permanent stuff. What, the IP actually where that's domiciled. How do you run that process now with advisors or trying to assemble them when, you're obviously trying to keep an eye on time and money at the same time?
Yeah, so we, as you mentioned, we have a rough playbook, right? And knowing that if we're taking one first step, maybe we'll start with a PEO, not knowing where it's going to go, looking at the size of the country of where it's going. Maybe we have a better rough idea of how large we want to expand our sales team in that country or engineering folks. But as you mentioned, sometimes, the M&A throws the wild card in, and finance is playing some catch up on that to figure out how we want to expand from there. So, there's definitely Michelle and I are not global tax experts in each individual local entity. And so that definitely pulls up, something that we always tap our advisors to figure out. Once we figure out, hey, we might be moving forward with M&A, or maybe going into a new country that we're not as familiar with, we'll tap our advisors to look at all the different implications in that, figure out what the risks might be going to the country too, and understanding what the right structure should be for us as we continue to expand, or from an M&A standpoint, what's their footprint already that would be overlapping with ours, or new places that we will be.
Right. Yeah. And just to add a little bit to that, as Craig mentioned, we've gone through a couple of acquisitions, right? And we created a little bit of a playbook in terms of how to handle it, because we are dealing with a very tight time frame. And so, we have to complete due diligence, right? Understanding the company that you are considering purchasing. What is their tax structure? What is their footprint, as Craig mentioned? Are they compliant? All of these things you have to understand right from the start, so that you understand what the impact would be on your own company. And so, moving past diligence, then you think about integration and how this company will layer into ours. Where does their IP sit? For us, our IP is in the U.S., but for another company, if it's sitting offshore, what does that mean for us? And then whether, just having this company will create new jurisdictions, new nexus, in whether it's on the U.S. side in certain states, or, on a global scale, what countries are going to be, entering into due to this acquisition. And then, as Craig mentioned, we have to understand that specific country's rules. And, I'm not going to say I'm an expert in every single country, so we do rely on advisors to really understand the nuances in a specific country, to understand what the risks are, what compliance will look like, what in the long term, what is it going to mean for us?
Yeah, for sure. So before we get into some of these stories about the lessons learned as we take a trip around the world with you into certain jurisdictions, so there's been mention of these advisors, right? And so, without talking about which ones are good and which ones are bad, maybe if you can tell us a little bit, and you've dealt with a wide variety of them, right? And there's a whole bunch of different considerations. Maybe just a little bit about what you've learned from these advisors, and what you've learned about these advisors, and then maybe just to round it out with maybe other resources that are helpful when you're trying to think through some of these things.
Michelle, you want to start?
Yeah, sure. I guess from advisors, and we did touch upon this before, but you really learn the specifics about certain countries, right? Especially if you're working with a global advisor, they've got experts all over the world, and speaking directly with that local desk, is often really helpful to understand, not only what the technical rules are, but what is done in practice in that, in that country and jurisdiction. What do their clients do? Just to get that practical advice, I think that's something that we have really benefited from them. And then, about them, I think what has really helped us sometimes was really just stepping back and understanding what is it that we really need, what are we trying to get out of these advisors. And so setting those expectations up front with them, when it comes to timing, or, what is the goal? What do we need? And from there, oftentimes it's a deliverable that is what we need, a deck, a presentation, or it's just a phone call, a Q&A discussion with everybody at the table from our side, just to make sure that we're having discussions live and making sure that, everything that we should consider, are talked about and addressed all at once. Craig, I don't know if there's anything else that you wanted to add.
Yeah, I would just add as well, we've definitely found it's not, there is no standard playbook, I feel like, going into a lot of these different countries as well. Everything's very specific, even for Datadog, if we're, it seems like from the outset, a standard model compared to some other company structures. Everything's very specific, and you really need to have all the facts and understanding and know what facts you need to understand the country's pieces as well, just to know how it all interacts. What's your customer engagement in the country? Who's making decisions on negotiations? How are you interacting with your vendors? You know, those types of different questions that you might not even know that you need to ask as you're looking into different countries. It's good to brainstorm with your advisors as you're trying to figure out what the best approach is for your company.
Definitely. Well, and a lot of what you said, both of you, was really good. The one part about expectations was good to hear, because that is a two-way street, right? So, you know, it's important for the company to understand what they think the scope of this will be. Obviously, there's flexibility that is built into that, but then the advisor meets it with their own expectation setting process, which also will need to adapt and evolve with this situation, especially as it may evolve or new facts come into play or what have you. And so, all right, good. Now we'll get to some of these stories. So lessons learned. I think you know, it's, you know, what we see sometimes when, you know, embarking upon this, where you're in a new jurisdiction, especially some of these in a sizable way. You know, you get a certain idea about what you might expect, and then maybe after there you find out things maybe are a little bit different. You know, you can see maybe things were more tricky than you had planned, or you know, just, you know, some of even what happens when you are trying to qualify the attractiveness of that particular jurisdiction. And so, you know, again, while trying to make sure that, you know, time and cost is spared. And so, you know, one big jurisdiction for Datadog is France. And so there's been a lot of activity there. That would be a great starting point if you could share with us a little bit about going into France.
Yeah, France was, if most of you don't know, our two co-founders are French. And so they started the company in the US. We're headquartered out of New York City, but France is near and dear to their heart. And so our first international expansion was into Paris. And now we have a pretty sizable engineering team based out of our Paris office at this point. So from there, that was our first step. Internationally, we've now grown, as I mentioned, into 10 different entities internationally, 30 different countries globally, with a PEO structure for other places as well as we continue to expand. And so we've gotten a pretty good playbook, you know, from that first step in going out there. And so, you know, there's a few different things on our checklist that we think about as we continue to expand, and definitely learning as from our French expansion, that as we get larger there and hit more milestones, I guess, from a company size there too. But you know, how are you setting up your payroll when you first get up there, just operationally? You know, as we continue to expand, these are things that as a company now, we have monthly meetings with all stakeholders that from a corporate standpoint that need to expand there, from the legal team, from the HR team. We're all meeting to see what makes sense as we look at our headcount growth and just seeing where we're going, along with our sales strategy team, meeting with them of where are you planning on placing new people over the next couple of years, so we can start doing some due diligence there as well. You know, how are you setting up your payroll? Do we have the right employment agreements as we go into the new countries, because each local law is a little bit different? Do we need to set up new bank accounts with our bank? How long is the lead time for that? What corporate documents do we need to get registered and a legal entity created there as well? What system integrations do we need? We use NetSuite, and so how do we integrate NetSuite with the bank to make sure that we're paying correctly, or tracking VAT, as the last group has mentioned too? You know, are there language barriers? We found that when we were in Japan, and hey, we go into Japan, no, it's, you know, the same playbook, but we can't even read the characters or try and figure out. You know, I don't speak Japanese. We can't understand the expense reports to know how much to reimburse or do a good check. And who do we need to tap in the local office? Do we need to talk to the office operations person to do our expense report reviews? So it's those types of things as we were going through to figure out next steps. But Michelle, you want to touch on some of the local taxes too?
Yeah, and I think, you know, starting with France, as Craig mentioned, because our founders are from there, you know, when Craig and I joined Datadog, the French entity was already created. So it's not something that, you know, we weren't part of the decision maker of, you know, how are we going to set this up? But we were almost on the reactive side, like, what do we do now? You know, how do we handle having such a large presence in France? And so from the tax perspective, what I've really learned being here was that, there's just so many different types of taxes that you might not even be aware of. It might not be specific to France, but just as an example, it's not just corporate income tax. From my end, that's the first thing that I think about. What's the tax rate, right? But then there's all these other ones. There's something called the CVAE, which is basically a tax on revenue. So the bigger we grow there, there's really a high operating expense when it comes to that. There's also social contributions and payroll taxes. There's, the employee also has their own taxes that they have to worry about that we in the US may not. So just understanding all of those rules, is very important, so that, from a finance perspective, we obviously, understand how much it's going to cost us to expand there, but also from an accounting perspective, making sure that we properly accrue for these items, so that we're not surprised, by a huge tax bill at the end. So kind of understanding all of that up front is really beneficial. And then, on the flip side, the great benefit that I've learned about France is that they have an R&D tax credit program that is actually refundable. So those of you that are familiar with the US rules, you need an income tax liability to use that credit. But in France, it's completely refundable. And so, that is something that's very beneficial for us. But along those lines, it's not easy. You have a lot of documentation that is required. It also takes several years for the French tax authorities to get you that refund, because they also have to do, a little semi-audit of it. And it also can disrupt the R&D department, the engineers, because of that documentation that's required. And so something that we're working on right now is really trying to make this process seamless for our teams, but also making sure that we're prepared with the documentation that's needed for tax purposes. And so, you hope that all of this is very straightforward, but there is a lot of people that's involved. So getting everybody at the table to discuss how we can make this, the most efficient is also part of the planning and the strategy, making sure we talk to project managers and they're aligned as to what we're trying to achieve. But not disrupting their day-to-day. So there's a lot of parties that are involved, when it comes to taxes. And so that's something that I just need to be aware of to make sure that we're successful in that.
Well, one of the things to add to on France as well that we learned on the payroll taxes too, we compensate all of our employees in equity that as we continue to expand. And so one of the lessons learned is France has sub-plans you can adopt on top of your equity incentive plan that changes the tax structure favorably for the employees and for the company too. And that's something that if you don't know to ask about, you might miss it. And so learned for our stock options and RSUs, sub-plan was needed in France to get that. I think the UK has a similar one as well. And so, it's one of those questions we've added to our checklist as we continue to expand to make sure that we don't miss it, because if you don't have it adopted, is when you expand, you miss the opportunity. So it's just one of those things that we've learned as we've continued to expand.
Perfect. Yeah, that was a good snapshot of France and just some of the, like you said, not less obvious considerations, actually things that could benefit the company and the employee. So what if we move a little bit east? Another country that Datadog had looked into was Singapore. What can you tell us about over there?
Yeah, so we've expanded into Singapore, looking at that as one of our hubs for APAC, and continue to expand. It's a great resource of a city for a lot of engineering talent that we've been looking at to continue expanding there. And we've noticed that they do have tax incentives that they offer, especially for heavy expansion into the city. So it's something that they've reached out to us and flagged it for us to continue looking at it. It's something that, from a cost-benefit standpoint, would have required a larger lift for us than the benefit would have been, but it was something that we did look into. But it's one of those things that we didn't even, when we first expanded, we didn't even necessarily know to really ask about it, but they had reached out, and it was worth looking into. Ultimately, we decided not to look at the actual benefit, but you just never know where there might be incentives locally here in the U.S. or internationally too.
Right. Yeah, and to chime in a little bit, yeah, the incentives that they offer there seem to be pretty beneficial. I think it's on job creation, and so it is something that we did consider. But given that we were still pretty new out in Singapore, our first priority was to make sure that our compliance, was in line, that we had a full grasp of what we were required to do when it comes in a tax and as well as finance perspective. I believe Singapore requires statutory audits. And so for us, we needed to make sure we had an auditor lined up to look at our financials. And so it, again, as I said earlier, I think it involved several parties to make sure that even just our compliance is up to speed. And so we have a team out in the international world that is helping us, making sure that our financials are, aligned with IFRS. Or the local GAAP that is required in that particular country. And so that's sort of been our first priority for the past year or so.
Excellent. Okay, great. Well, if we're still in that part of the world, so in another Asian country is you pursued an opportunity, I think it was in South Korea, correct?
Yep. So we've taking a step back, Datadog had expanded into South Korea through a PEO. We've hit our own internal critical mass, and we've set up an entity, or decided to set up an entity. Almost a year ago, we were going through the process and said, we're going to grow exponentially here. So it's been quite a process, especially through COVID and through internally with our own company, just getting all the right signatures lined up and doing everything we needed. What signatures were needed to register the company and making sure that everything gets floated around correctly. And offices were closed during the process too. That it's taken 9 months now to set up our South Korean entity. And so, just something to keep in mind from our own lesson learned, that it's not we need to set up an entity. You're going to have one in a couple of weeks. It could take months if everything isn't lined up, or just the process itself just takes a while to make sure you get everything stamped and approved. And even from there, once you get the company registered, you still need to, again, from an operational standpoint, set up your payroll system. So now that we have a legal entity to engage ADP with, we're able to engage them and start setting that up. We can start talking to the bank about setting up a bank account now that we have a registration number as well. So it's those things of lead times that really are very big in this international expansion.
All right, great. Maybe one more country. Spain was another country I know that you had moved into, right? If you have anything to share about moving into that, that'd be great too.
Yeah, so Spain, we had a few people there, our sales team out of Spain. We had expanded there through a PEO as well. Not sure exactly how we were expanding, and I think we were starting to get to that critical mass of maybe we should look at an entity. And then from a reactive perspective, there was an M&A that came up that we decided to move forward with that had an entity set up in Spain. And so last year we acquired a company that had a legal entity there, and we were able to move our PEO employees to that entity, which helped us out. It was already established and made it a lot easier and quicker, even though Spain is probably one of the countries that have a longer lead time to make any changes with. So that was really helpful from us to make that change from international expansion pretty quickly, have all the systems lined up, ready to go too. They had accountants that were helping them already. They had a payroll system that was lined up. And so it was very easy to make the switch and have operations up and running in Spain through the M&A that it would have taken a year probably to get up and running otherwise.
Right, and Spain is a good example of where we had a little presence, but we ended up creating an entity through an acquisition, and so that was a unique situation, because not only is the timeline short in terms of due diligence and understanding the company, but also, as I mentioned earlier, what's that next step look like? How we as Datadog, what do we need to do to make sure that we, we're ready to go in Spain from a tax perspective? Again, talking to advisors, making sure we understand all of the compliance requirements, the due dates, and making sure that operationally we are ready to, stay compliant, kind of take the baton from this acquired entity and making sure that we keep running with it, and just stay on top of all of our tax obligations.
Great. Okay, good. Well, so maybe before, we always like to see if there's anything else you'd like to pass along. Maybe we'll just see if the audience has any questions. I meant to mention that in the beginning. If folks do want to type in any questions for Craig and Michelle, they can do so in the chat box in the GoToWebinar software. Maybe while we're waiting for some of those, and of course, I know folks always like it when things end early, so maybe we'll go that route with it. But maybe, Craig and Michelle, if there's anything else you do want to add, maybe before we wrap this up, please feel free to do so.
Yeah, I think one other lesson learned, just to add to this whole thing, again, we compensate our employees through equity, and so we have a stock option plan. We now give out RSUs after our IPO, and so definitely consider that as you're continuing to expand. Each country has its own laws, rules, regulations beyond even the sub plan that I mentioned earlier, to make sure from a payroll perspective you understand how it needs to be reported through. Every country is a little bit different, including the U.S., even state by state. So that's something that we've spent a lot of time on, to make sure, especially as we continue to grow, that we understand the rules for each new country that we go into, working with our advisors to understand the local laws, making sure that we are in compliance with everything, and doing the best that we can for our employees to make it as simple as ever possible, because everything's a little bit different, especially with U.S. stock given to them.
Got it. You know what, there is a question for, so it is, have you ever gone into a jurisdiction and had to pull out, whether it was Datadog or a previous employer, because of just changing, changing circumstances, what have you, if you've got any experience with that?
We at Datadog haven't had that yet, so always continuing to expand.
Yeah, for sure, exactly. That might be it. So I think we're good. We can actually wrap this up about 10 minutes early, and maybe with that I can turn it back to the folks that kicked this off at the beginning. But Craig and Michelle, definitely want to thank you again. I know you did a lot of preparation for this, and just thank you for just being a part of this annual summit. So with that, we'll kick it back to
I
Kim.
will. Thank you, Dave, and thank you, Craig and Michelle. I really enjoyed your comments on expanding globally. I think, know the country and reach out to your advisors early and often. France is one of those countries that I think is one of the hardest to get in and out of. Have you had any experience having to fire employees in France?
It is, it's a very employee-friendly country, definitely.
It is, yes.
Yeah.
It's one of those things I've heard horror stories about. Trying to getting rid of an employee is almost impossible. So I'm glad you're having a good experience there. Very interesting. Also, I think the idea of compensating foreign employees with U.S. stock and what the different options are available for in various different countries, and knowing those rules is really part of something that we don't see often with our clients. And so it's interesting to hear you talk about it, and that you're getting your bank accounts open. Sometimes that's the hardest piece of entering a country, is getting that bank account open.
They don't make it easy.
No. Okay. Thank you very much to Dave, to Craig, to Michelle. Thank you to our HLB panelists, Suraj, Nick, Bettina, and Jason. Thank you to Chaya for moderating the panel. Thank you to Josh and Calvin for updating us on the new Biden tax proposals that are coming out. We are going to see a lot of changes coming, and you can subscribe to international tax updates at Withum, and we look forward to reaching out to you in the future. If you have any ideas for us to present to you, we'd be happy to do that, and we look forward to next year's Global Summits. Thank you very much for participating. Bye-bye.
Thank you everyone for joining us today. We will be sending a follow-up email with the PowerPoint presentation and webinar recording. Both will be emailed to all registrants later. Thanks again.